As we continue to enjoy, or suffer, the vagaries of the Great British Summer, central bankers, economists, investors and politicians will all be looking at the misery index this coming week. Remember that this benchmark adds together the unemployment rate and the prevailing rate of inflation, and updates on both are due from the Office for National Statistics on Tuesday the 15th for jobs and Wednesday the 16th of August for prices. The latest readings were as follows: 7.9% for inflation in June using the Consumer Price Index or CPI as the benchmark. That was still 4 times higher than the Bank of England's official target, but at least it represented a welcome drop from May's 8.7% and last October's peak of 11.1%. And also for unemployment, the reading was 4%, and that was for the last 3 months to May. Less encouragingly, that was the highest figure since December 2021, although it is still low by historic standards. So, for May, the last month when we have the data for both, the misery index score was 4.0 plus 8.7 for a total of 12.7. That's well above the post-January 2000 average of 7.9, and it will therefore be interesting to see the latest reading in the monthly consumer confidence survey from consultants GfK. That's also due in the coming week on Friday the 18th. After a big rally from the autumn lows, the headline index lost 6 points to minus 30 in July, and there has to be a chance that the combination of higher rates on debt and a renewed surge in oil prices to around $85 a barrel could be taking its toll once more. We shall see. Note how the misery index, shown here in a reverse order, seems to bear a close relationship with the GfK Consumer Reading Survey, and that does, I suppose, make sense. On the company front, the deluge of quarterly, interim or full-year reports is finally slowing down on both sides of the Atlantic, although we still have a busy week ahead of us nonetheless, especially for followers of the insurance sector, and I'm sure there are some of you out there somewhere. Names which may be worthy of further research because of what they say about themselves, their industry, or the economy more widely include the following, although do please note that some of these dates could yet be subject to change. Lock and Store on Monday the 14th of August, Just Group on the 15th, Aviva, Admiral, Essentra, Balfour Beatty and Restore on the 16th, Rank and Hochschild Manning on the 17th, and Capital on Friday the 18th. But the company which could just cause the biggest fuss in the week ahead is Legal & General. The life insurance, pensions and investment giant is scheduled to release its first half results for 2023 up to June on Tuesday the 15th of August. Now the shares haven't done much over the past year, losing around 15% of their value, despite the ambitious 5-year capital generation and earnings growth plan laid out by Chief Executive Sir Nigel Wilson and the board for 2020 to 2024. So Nigel actually steps down at the end of this year, before the end of that 5-year spell, but he will presumably be looking to go out on a high after almost 12 years in charge, and these interim results will initially be benchmarked against the 20 to 24 plan. Remember that its key tenets are capital generation of £8 to £9 billion in total, dividend per share growth of 3% to 6% per year, and growth in earnings per share, or EPS, to exceed growth in the dividend. And the FTSE 100 member intends to achieve all of this while embracing what it terms inclusive capitalism and establishing itself as a leader in ESG, or environmental, social and governance investing. To assess whether Legal & General is on track, investors and analysts will look to 3 key sets of numbers. The first is operating profit on a divisional basis before group interest costs and investment projects and expenses. Legal & General made £1.4 billion in the first 6 months of 2022, on its way to £2.9 billion for the full year. So that's the benchmark for the first half of 2023. Analysts will then dig into the details of the performance of Legal & General's 4 divisions: institutional retirement, capital, investment management and retail savings, insurance and pensions. Particular features to note here will be the new business flows in bulk annuities, the performance of alternative asset investments, net fund flows, passive and active at the investment management operation, and the impact of rising interest rates on bond and equity portfolios. The second key figure to watch is earnings per share. The comparative figure from the first half of 2022 is 19.3 pence a share. And the third and final one is the dividend. COVID-19 interfered with the growth streak in the annual distribution that had begun in 2010, but the payout grew in 2021 and again in 2022, and analysts have penciled in further increases for this year and next. The first half payment a year ago was 5.44 pence a share. As a final point, analysts will look to Legal & General's solvency ratio. This measures the ability of an insurer to meet any claims it may encounter and its financial strength in the face of unexpected falls in asset prices or increase in liabilities. Under the terms of the Solvency II regulatory regime, Legal & General ended 2022 with an all-time high solvency coverage ratio of 236%, equivalent to £9.9 billion of surplus capital. I hope that you and your families are all in good spirits and keeping well despite the wet weather. Thank you for watching, and I look forward to seeing you next time.